All right, thank you all for joining us. My name is Alex Goldfarb, and I'm joined by my colleagues Konstantin Malishkin, Nick Cucciarelli, and Dominic Negrato. Today we're presenting Staar Surgical as a buy with a price target of $46.15, representing 23% upside from current levels. Our variant perception rests on three underappreciated premises. First is the total addressable market. 4 million refractive surgeries are performed each year, generating over $6 billion in patient fees annually. Over 1/3 of the global population has some degree of myopia or nearsightedness, and this figure is expected to reach 50% by 2050. An aging population and increased screen time provide strong tailwinds to this trend. Second is Staar's ability to take share. Demand for best-in-class technology that is safer with equal efficacy should drive share gains from LASIK and other competing procedures, and US FDA approval offers significant upside option to this growth. Lastly, ability to take price over time. Staar's implantable Collamer lens generates nearly double the revenue for practitioners compared to LASIK. And while only capturing 12% of procedure economics, we think there's room to take price once Staar's land grab strategy matures. So what's driving the stock? Three linchpin issues are driving the stock today. As mentioned previously, the total addressable market is key. The broad vision care market is roughly $70 billion today and is comprised predominantly of glasses and contact lenses. Refractive surgery accounts for less than 10% of that, leaving significant market opportunity for growth. And as a subsector, any shift from laser surgery like LASIK to implantable lenses can drive significant demand for Staar's products. Second driver is margin expansion. Since turning a profit in 2018, Staar has expanded gross margins from 70 to 75%. With management guidance indicating improvements in manufacturing efficiencies, the market will continue to expect margin to expand. Lastly, revenue expectations. As a high multiple stock with revenue growth well above its peers, any deceleration in top-line numbers could result in multiple compression.
Next, we're going to turn to some background on Staar. The company makes implantable lenses for the eye that are used in refractive surgery to treat myopia or hyperopia, which lessens or eliminates the reliance on glasses or contact lenses. The company's principal product is the implantable Collamer lens, or ICL, which includes the Evo Vision product line. ICLs comprised 86% of 2019 revenues, up from 75% in 2017. The company had a breakout year in 2018. Revenues were up 37%, driven by 48% growth in ICL sales. This drove the first year of profitability, which continued with 21% revenue growth in 2019. Gross margins have been especially high for Staar. In 2019, they measured 75%, and over the past several years have increased from the low 70s as the revenue complexion has shifted more towards ICLs. Breaking down the revenues by geography, this is a very international heavy business. About 60% of 2019 sales came from Asia, with China measuring 43% of the total, followed by Japan at 18%. Turning to share price performance, this has been a historically volatile stock, but the trend has clearly been up and to the right over the past several years. The turning point was 1Q18 earnings, where revenues accelerated meaningfully and management significantly moved up their guidance, which led to a 26% move higher in the stock. In terms of the volatility, it is worth mentioning to any potential investor just how big the fluctuations are. From 2014 to 2019, so preceding the cluster volatility from COVID-19, STAA had 127 trading days that included a plus or minus 5% move in the stock. This compares to 0 for the S&P 500. Karen Mason is the president and CEO and has held the post since March 2015. She held multiple chief executive roles within the healthcare industry and joined the STAA board as an independent director in 2014. The stock has done very well over her tenure. Since she was appointed CEO, Staar shares have appreciated 460% relative to a 5% decline in the Russell 2000. Insiders own 4% of shares outstanding, with the CEO owning 2%, which equates to about $28 million worth of stock. It is notable that she has a particularly large change in control, which is nearly $20 million. There does not appear to be a natural successor to Ms. Mason, and she is 65 years old, which lends credence to the company being a takeout candidate. With respect to institutional ownership, what sticks out is that Broadwood Capital owned nearly a quarter of the shares as of the most recent filings. They have proven to be a long-term holder, owning a significant stake since 2004. However, STAA comprises nearly half of their AUM. Increased redemptions or a change in view could pressure the stock. We talked to Broadwood and they significantly downplayed the factor of redemptions given they don't take outside money. They have twice publicly agitated for change, primarily in board composition, but voted for all 5 directors at the 2016 annual meeting.
So what is Staar's market opportunity? Staar's current target market of people with myopia is estimated at $1.9 billion globally. Of those 1.9 billion, management estimates only 35 million qualify for EVO based on income, proximity to a surgeon, and willingness to undergo refractive surgery. Staar's pipeline, however, includes the potential to serve the presbyopia population, as well as offer a companion procedure to those undergoing cataract surgery, providing two additional attractive market verticals. From a geographic perspective, as Nick mentioned, China accounts for over 40% of Staar's revenue and is a key driver of future growth. At the most recent Analyst Day, Staar management disclosed their market share by country, with details implying a $463 million market opportunity in China. However, management has a history of underpromising and over-delivering, and based on an estimated 1.5 million LASIK procedures annually in China alone, we think the Chinese market opportunity can be 3 times what management is implying today.
With respect to competitive landscape, we want to highlight the diversity of companies. The main competitive threat are companies focusing on marketing lasers, such as Alcon, who supply machinery to eye surgery centers offering LASIK. In addition, Offtech manufactures premium IOLs, and Aurora Lab manufactures affordable IOLs. Finally, all customers seeking corrective eye treatment can always opt for non-surgical solutions. Staar is in a unique situation where competitors can range from LASIK, other IOL manufacturers, to non-surgical options. With respect to the competitive moat, we wanted to highlight 3 key advantages. First, its proprietary technology. Second, the company's history of overcoming regulatory hurdles. And third, the safety and reversibility of their product. The largest competitive advantage stems from its proprietary technology, which is a biocompatible collagen lens, which is used in the ICL and IOL products. Our conversations with shareholders made it apparent that they agree this technology is a unique differentiator relative to their competitors. It has an excellent safety profile and is exclusive to Staar. In fact, the company has thwarted attempts to steal this technology many times since its development. Other IOLs use silicone or acrylic and do not have the biocompatible nature that Collamer has. Next, we wanted to highlight how challenging the regulatory approval process can be. Our research indicates that the probability of device approval from the initiation of preclinical work equates to approximately 1.5%. Previously, Staar developed, patented, and licensed the first foldable IOL in 1991, and in each subsequent decade has successfully gained regulatory approval for various IOL and ICL products globally. In 2020, the company was approved for U.S. clinical trial for their Evo Visian ICL product line, and it should be noted this product already has regulatory approval in various Europe and Asian countries. We consider Staar's experience in the regulatory approval process a competitive advantage against new entrants. Next, Staar has a distinct advantage over its LASIK competitors, namely in terms of its safety, as it does not cut into the cornea and is reversible. Visian ICLs are effectively semi-permanent contact lenses designed to be implanted behind the iris. This is the first surgical option for people who have thin corneas or any complications regarding LASIK and boasts fewer side effects. Although not as well known in the US as LASIK, the company has an impressive 20-year track record with over 1 million eyes that have been implanted with a 99% satisfaction rate. We believe the United States is a large, underpenetrated market. The product fits the needs of patients with an improved safety profile and has high technological and regulatory barriers. Next, we wanted to go over Staar's competitive strategy by looking at Porter's 5 forces. Rivalry among competitors is highly concentrated. The top 5 laser surgical makers boost 67% of total market revenue. In addition, there is a current threat of low-cost IOLs appearing in China and India. Threat of new entrants is low, as the regulatory approval process and R&D costs create a high barrier to entry. Supplier power is low, as the majority of raw material is used from a diverse range of suppliers. Buyer power is high, as customers can opt for LASIK. In addition, Staar's largest customer is Shanghai Langshang, which accounts for 43% of net sales, effectively acting as its distribution network into China. However, one advantage is to specific customers that are ineligible for laser-based surgery. Threat of substitutes is high, as LASIK still owns the lion's share of the market, although substitutes can also come in the form of non-surgical alternatives, which are more affordable.
So as we discussed before, in 2017, management provided 3-year targets of 15 to 20% revenue growth and 25% unit growth and profitability through 2020. As you can see on the slide, the company has demonstrated strong top-line growth over the period, increasing revenues 37% in 2018 and 21% in 2019. Staar has outperformed their targets due to strong growth in China and improved cost controls. Looking ahead, the slide represents management targets through 2022, accounting for the temporary impact from COVID-19 with a slowdown in the first half of the current year. This also takes into account the management COVID-19 guidance update provided on April 13th. Looking at the valuation ranges, you can see there is significant dispersion in the DCF output particularly. We do not give meaningful weight to comparable multiples as these companies offer wide-ranging product portfolios with varying growth rates, and there's no true pure play comp. We've isolated a stable case where we show the growth from the DCF to reflect value of the international opportunity only, with the US remaining stable. The analysis shows the implied price for the US market opportunity of approximately $2.50. We kind of illustrate that here a little bit, that investors buying the stock at the current prices are effectively paying a fair price for the international opportunity, taking management forecast as a given, and are purchasing a real option on the US opportunity at a significantly undervalued price. We've provided summary of the scenario drivers for reference. We've developed 7 scenarios based on our analysis, as well as the 8th scenario showing management forecasts. Overall, we believe Staar is well positioned to address the growing market of MIOPs globally. Favorable economics of practitioners support the company taking share from competitors. The management has proven its ability to deliver on growth and margin targets, which we reflect through higher weights to the upside cases. We rate the stock as a buy with a price target of $46, representing 23% upside from the current levels.